Municipal bond market. The municipal bond market is where state and local governments raise money by selling debt securities to investors. In exchange, investors receive regular interest payments and the return of their principal. These funds typically support public projects like schools and highways, and most municipal bonds benefit from tax-exempt status, making them attractive to income-focused investors. The market operates both for new bond issues and for trading existing bonds. Municipal bonds offer a key advantage. Their interest is usually free from federal income tax and often from state and local taxes if you live in the issuing state. There are two main types: general obligation bonds, backed by the government's full taxing power, and revenue bonds, secured by specific income like tolls or utility fees. Because of the tax exemption, these bonds are especially popular with investors in higher tax brackets who can keep more of their earnings. To compare a municipal bond with a taxable bond, you calculate the taxable equivalent yield. For example, a 3.5% muni for an investor in the 35% tax bracket yields about 5.38% on a taxable equivalent basis. This means that 3.5% muni can actually outperform a 5% corporate bond after taxes. When evaluating municipal bonds, investors rely on tax equivalent yield, credit ratings, and yield curves, but common mistakes can undermine the tax benefits. First, check for AMT status, as private activity bonds may trigger the alternative minimum tax and reduce your returns. Also, be mindful of liquidity. Smaller issuers can be hard to sell, so consider funds or larger issues, and watch for call provisions that could force an early redemption at an inconvenient time. Finally, while state tax savings are valuable, avoid over-concentrating in one geographic area to reduce local economic risk. In the municipal bond market, careful evaluation of credit quality and risk is essential for conservative investors. Use ratings from Moody's, S&P, and Fitch to assess safety, with general obligation bonds from AAA-rated states and cities being the most secure. For revenue bonds, deeper analysis of project cash flows is needed, while a bond ladder of staggered maturities helps manage interest rate risk.